problem is this, that we've kind of asked too much of our policymakers, or they've asked too much of themselves. QE policies started off, I would suggest, as being a bit like a powerful antibiotic designed to cure a really significant problem in the global economy. In that sense, they work because you avoided this nasty depression. But they've now become, I would say, a bit like an addictive painkiller. Nice to be on, incredibly difficult to get off, but also potentially associated with damaging side effects.
If you look from 40,000 feet and why we got into this mess, perhaps the most simple explanation is the US didn't save a damn thing, China saved an idiotic amount. And so this decade is all about China being a bit less like the old China, a bit more like the old US, and vice versa.
The financial sector is back on its feet. C&I loans are back to where they were. They've re-hit their peak of 2007. Bond issuance is higher than 2007. High-yield bond issuance 4 times what it was in 2007. Charge-offs for bad credit for banks, basically back to 30-year averages. Availability of credit for car loans, all that sort of thing, excellent shape, record bank profitability. So I think the banking system is now open for business.
I would suspect that if you want to really solve the Eurozone crisis once and for all and deal with the whole thing, you need the fiscal and political union, and you probably need to have a one-off program of debt forgiveness, a bit like the Resolution Trust Corporation in the US in the 1990s after the S&L crisis. But getting to that from where we are currently is still incredibly difficult.
The main reason why China has slowed, in my opinion, is because they deliberately slowed the damn place. And I've just spent a bit of time there. In fact, the past couple of weeks, spent a bit of time with some Chinese policymakers here. And I am really impressed by most of what I hear. This is a country that knows about the scale of its challenges, in my opinion, and tries to confront, certainly the economic ones, tries to confront them all, in complete contrast to India.
I'm the most excited about Japan that I've been in 20 years. Mr. Abe has captured the imagination of the people. There's been more emotion and more excitement about the policies than I expected.
There's a habit amongst policymakers, and indeed amongst economists, in policy options, opting for what I'd call the theological option. You pray for a strong recovery.
Every time the Fed has raised interest rates, the stock market's always gone down. It usually goes down 5 to 10%, and it usually lasts 3, 4, 5 months. And 6 months later, the stock market's always higher than it was when the Fed first took its action. And I think we need a little bit of tough love out there. I mean, you can't have sugar water forever.
If the cause of the crisis in the first place was global imbalances and very loose monetary policy, then our answer to the crisis is global imbalances and very loose monetary policy, which strikes me as being a really odd argument. It suggests that there is a danger of some kind of bigger financial dislocation again over the next 3 or 4 years.
It's so fashionable to believe that Germany gets everything right, and Germany ranges from winning European Cups to God knows what else. And if you look at some of the underlying real evidence about reform and productivity, some of these guys that are being put under the cosh in continental Europe, Ireland in particular, perhaps Portugal, in my opinion, more than people give credit for, perhaps Spain, maybe even Greece, they're doing structural things that they wouldn't have done without the crisis, in my opinion.
The benefits of QE-type policies have gone to primarily a minority in the population. It's a kind of a Main Street versus Wall Street story. Wall Street's done well, Main Street's done badly. Or in the UK, the QE has worked through 2 different channels. It's lowered the exchange rates, helped to push up headline inflation, squeeze real wages. At the same time, it's lifted the value of financial assets. So the few who own lots of financial assets have done really, really well. The many who depend on wage income have done much less well. So you've got these peculiar liquidity effects, which have created, I would argue, a gap between financial hope and economic reality.